How shorting options works. Shorting options might sound confusing at first. Selling something you don't own. What does that even mean? Don't worry. In this video, I'll show you how shorting options works using simple examples. By the end, you'll see exactly how it works in practice. Let's start with the basics. In the real world, you can't sell a car unless you have one, right? But in the world of stocks and options, you can short something you don't own. When you short, you're betting that the price will go down. A regular investor buys low and sells high. A trader shorting something sells high and buys back low. When shorting an option, you make money if the price drops. Let's break this down with an example. Example 1. Shorting a call option on Apple. Imagine a trader shorts a call option on Apple when it's priced at $6. They collect $600 into their account since one option contract represents 100 shares. If the option's value rises to $9, it's now worth $900, which means they're facing a potential loss of $300. But if Apple's stock price falls, that call option could expire worthless, allowing the trader to keep the full $600. Watch out, shorting options is risky. If the stock price skyrockets, your losses could be unlimited. For example, a trader shorts a call option on Nvidia at $8.05 and collects $805. But Nvidia's stock surges, and at expiration, the option is worth $10,692. That's a massive $9,887 loss on a single trade. Shorting put options, a bullish strategy. Shorting put options works the opposite way. You profit if the stock price stays above the strike price or goes up, but there's still big risk if the stock price crashes. Example, short a put option for $2.50 and collect $250. If the stock stays above the strike price at expiration, you keep the full amount. But if the stock crashes, you could face significant losses. The smart way to short options. If you're going to short options, I always recommend using a spread to reduce risk. Spreads limit your losses while giving you a clear profit potential.